But yes, I am a son of someone who has the pension. Very jealous of what he's got, but I'm very, very happy for him,
Good
of
for them.
course. But I need to make my own pension. So let's talk about how we can modify this portfolio and talk about your four-fund portfolio. This is getting slightly more complicated, but again, not too complicated for people who are going down this path of DIY investing and realizing that this can be done well through index fund investing and automation. So talk to us about four fund.
So let me talk about a two fund and a four fund strategy. A little
Sure.
different two fund strategy than the target date fund. Let's just look at investing in individual ETFs, exchange traded funds or mutual funds. The two ways you can do it and get almost the same long-term return. Go back to that 10% return from the S&P 500. You could actually build a portfolio that combines the S&P 500 and small cap value. And let me suggest something radical, that you have half of your money in the S&P 500 and half of your money in small cap value. Now that combination has historically produced about 2% more than the S&P 500. And here's the part that's fascinating, that if you look at all of the negative years since 1970 for the two fund strategy and the S&P 500, and you added up all those years that they lost money, because they did lose about 25% of the time, the S&P 500 lost more than the combination. And how can that be? Because these two equity asset classes don't go up and down together. And there are years small cap value does really well and the S&P 500 actually loses money. So this is magic when you can put together two asset classes. Now, if you used four asset classes, and they're easy to identify, the S&P 500, large cap value for 25% each of those two, 25% in small cap blend, that means some value and some growth, and 25% in small cap value. Those four funds over the last 96 years have made 1.8% better than the S&P 500. And here is what is so absolutely marvelous is we have what we call a quilt chart that you can see the returns 1 year at a time since 1928. I love numbers. And you can compare those four different asset classes 1 year at a time. What was number one? What was number four? And you'll see this amazing difference from the top to the bottom. You have to ask yourself, is that the same stock market? How can one be up 22 and the other one's down 7? Well, that's the way the market actually works. And people need to understand that volatility, that randomness. But the four fund strategy, never at the top, never at the bottom. Basically hanging right there in the middle, because it's the average of these four great long-term great equity asset classes. And so instead of having something that's bouncing all over the place, you could, in essence, you could select the one that is close to the middle. Now that means you never get to be number one, and that means you never get to be number 4 or 5, if you want to look at it in that way. And that's okay, because what we are looking for is a return that will meet our needs with as little volatility as possible. And the only thing I can't stamp on that comment is the word guaranteed.
Absolutely.
But you and I are both committed to making sure people buy cheaper index funds that leave more money in your pocket. That doesn't guarantee you're going to be number one. There's going to be some active money manager out there that's probably going to beat the index. In fact, over 20 years, about 1 in 10 managers is able to beat the index. The problem is you can't find them beforehand. You don't know who they're going to be. So I know that we're both on the right path The question is, how do we reach people? You're reaching them, and how do we present the information that they get it? Not from a I'm not going to say I'm not a salesperson, but I have no income generated out of the work that we do. And the bottom line is that we're simply trying to get people the best that we know, but then you got to see the information to make that judgment.
Absolutely. Absolutely. Now there's somebody listening and they hear the variety of funds you're talking about in this equity for fund portfolio.
Yeah.
And they're thinking, well, what about just buying a total stock market index fund, Paul? Isn't that the same thing? Can you tell us why it's not or why it is?
Well, I can tell you why it is. In fact, the actual return, again done by the academics, of the total market index going back to 1928 is a little bit under the S&P 500. They're virtually the same investment over the long term, and the reason they are is because they are cap weighted returns. And so the very big companies in both the total market index and the S&P 500 are driving most of that return that you see every year. So either one of those are fine. But what, of course, the total market people will say is, well, yeah, but we have some small cap value and we have some small cap growth. What they don't tell you, and they know, is that historically small cap growth has been a lousy investment and has compounded at a little over 8 versus about 13 for small cap value. Okay? You put those together, which they've done, you have eliminated the advantage of small cap value. And so what happens is you end up getting a return that's virtually the same as the S&P 500. If they would just build that total market index so it didn't have any small cap growth, it would improve the return of that portfolio. But the reason that I like being able, and what we do on our site, is we tell you what ETFs, we have what we call best in class ETFs, so people can decide, yes, I want to be this kind of an investor. Oh, and here are the mutual funds or ETFs that I should use, so that you can really be a do-it-yourself investor. But the reality is that even when you talk about small cap value, there's a huge range in small cap value funds. A lot of people don't know it, but there are 6 major indexes that call themselves small cap value. And the difference in return over the last 15 years, on average, is 2.5% a year. Well, that tells me somebody
Wow.
needs to spend some time to figure out, why did some end up towards the top and some ended up towards the bottom?
Yeah.
That's not true with the total market index or the S&P 500. They're all kind of the same except for what the expenses are. But it is true about these asset classes that the portfolios are put together in different ways. And that means they have different long-term rates of return. And our desire, and what I'm recommending for people to do is the same that my wife and I did for our newborn granddaughter a couple of years ago. We put money away for her retirement, and we divided the money between a S&P 500 like fund and a small cap value fund, and we picked the best two that we could, that's there to serve her for the next 90 to 100 years.
I love that. I love that. Now, one thing that you and I have alluded to a lot in this conversation, but maybe people didn't catch on to, is the importance of controlling fees as well.
Yeah.
So we keep saying index fund, but a lot of people who get involved in looking into their 401k or maybe working with an advisor. Can you talk about the importance of understanding fees and the impact?
Well, it's huge. It's huge because it's guaranteed. It's a risk that is guaranteed to happen to you. And if you compound high fees for the rest of your year, you're doing exactly what Einstein theoretically said, except backwards. You are reducing your return over the rest of your life. And so that fee difference is huge. Now, remember that one of the reasons those fees are high in many cases is because the funds are actively managed. So let's just follow that bouncing ball. In an index fund, number one, you get more companies in the index than you do in an actively managed fund, less risk. You have lower fees in an index than an actively managed fund, guaranteed less risk. We get a portfolio that is guaranteed, almost guaranteed, to match the return of the index you want to be in, whether it's large or small or value or growth. Whereas the active manager is out there doing their very best to pick the best stocks. And sometimes they aren't even obligated to be only in big. They could be big or small or value or growth. They're just looking for the best way to make you money. That is a wonderful desire. There is so little evidence that it ever happens that you realize, wait a minute, I can choose to be in the index, and only 1 out of 10 active managers will do as well as I do. Why would I take the risk of picking a manager who underperforms? But it gets worse than that, Andy. When you say somebody underperforms, you might ask, by how much? And many of those people, because there are people who actually track actively managed funds, and they show here's the return for the first quartile and the second quartile and the third quartile and the fourth quartile. Well, what if it just so happens by randomness, because a lot of people believe those returns are in fact random, you end up in the bottom quartile. Instead of a 10% compound rate of return, you get a 7. And yet that manager was trying everything they knew. But it wasn't until 1976 when John Bogle came out with the index fund that people started to get it. They laughed at him. They mimicked him. I mean, they made fun of him. Called it Bogle's folly. Who would ever want to be in a fund that wasn't managed to make more money? Well, the fact is now we know what's happened, and indexes have become the major investment. And by the way, most 401ks are automatically going into target date funds, and good ones are built with index funds. So you can own the target date fund, and it holds index funds so that your expenses are kind of like as low as you can go.
I love this. I love this conversation. Thank you so much. And thank you so much for your passion on this topic. I love getting financial education out there that truly helps people
Great.
on their mission and just
Thanks.
makes it a little more simple, because it really can be simple. And I know that's your mission.